Good morning, lecturers and tutors. We are Group 130, and today we'll be doing a presentation on Murchinson metals, in short, MMX. The principal activities of MMX include mineral exploration, project development, and iron ore mining operations. The consolidated profit for the year 2012 is $2,305,000 profit after tax. This is a huge improvement from the $16 million in loss in 2011. The profit for this year was due to the disposal of their assets. There is no CEO for MX, however, Greg Martin, the managing director, it has the controls and powers of a CEO. His remuneration amounts to $3 million. The auditors for MX is Ernst & Young, Perth. Their audit fees for 2012 is $222,000. There are no foreign subsidiaries or entities, but MX has 6 wholly owned subsidiaries. Next, Paul will be speaking.
Hi, good day everyone. My name is Paul. There were no associates in MX during 2012, and MX has sold its cross-land resources and OKG port and rail to Mitsubishi. As for a year ended June 2012, the company has only one interest left in jointly controlled operation, which is Hiew mineral explorations. There are no good consolidated goodwill, and the company defined cash generating unit as the assets that are largely independent of the cash inflows from the other assets or groups of assets cash generating units. MX is a tax consolidations group. The group has identified one operating segment, which is mineral resources investment activities in Australia. Each area of operations has been aggregated, and therefore the operations of the group present one operating segment under AASB 8 operating segment. This is the diagram of MMX group structure. The red one are the ones that sold by MMX to Mitsubishi Development, and the purple one was left in MMX group structure. Please note that the percentages represent an economic interest applicable to the parent entity. Next, I will pass it to Genevieve.
My name is Genevieve. I'll be discussing the accounting methods used by MX Group for the subsidiaries. MX used for the consolidation financial statements, the assets and liabilities for all the subsidiaries were incorporated as at the 30th of June 2012. A subsidiary is defined as an entity over which the group has the power to govern the financial and operating policies so as to obtain the benefits, and is generally accompanied by 50% of the voting rights. As stated before, all the subsidiaries are wholly owned. The acquisition of subsidiaries prior to the 2009, 1st of July, the purchase method was used as per ASAB 3. This form of accounting involves allocating the cost of the business combination to the assets acquired and the liabilities assumed. As stated, there was no goodwill, but after any subsidiaries purchased after the 1st of July 2009, the equity method is used. Associates are all entities over which the investor has significant influence, but not control or joint control. As stated previously, there are no associates in the group, but the associates can be accounted for using the equity method or the proportionate method. It's interesting to note, the investor, that is a parent entity, a cost method is applied to the separate financial statements for the investor. Jointly controlled entities is a contractual arrangement whereby the two or more parties undertake an economic activity that is subject to joint control. MMX uses the equity method. All ventures may record the investment in jointly controlled entities at cost or at fair value in separate financial statements. Ventures are parent entities must use the proportionate consolidation or the equity method for associates. Jointly controlled assets. The group, as venture, includes the interest of jointly controlled assets in the financial statements by recognising the group's share of the jointly controlled assets, liabilities, and the group's share of expenses incurred in respect of the joint venture as per ASB 131. Thank you.
Good morning, my name is Travis. With the impending suite of Accounting Standard Board's recent amendments to their set of reporting standards, the latest implications of these amended frameworks has yet to be assessed for the corporate group Murchinson Metals Limited. In regards to AASB 10, the major difference between this standard and the respectively superseded requirements is that it builds upon the facet of control as the principal determinant as the basis for consolidation. However, given the simplistic corporate structure that is Murchinson Metals Limited, illustrated earlier in this presentation, this new consolidation model should have no ramifications upon the group's consolidated financial reporting statements. AASB 11 was immediately designed to supersede prior standards applicable with the financial reporting by entities that have any interest in arrangements that are jointly controlled. Pertinent to this, the predominant reason behind this reformation was to exclude any potential options in accounting treatment for each type of joint arrangement in order to rectify any potential impairment in comparability. However, given that Murchinson currently accounts for these entities in accordance with the equity method, it can be concluded that this standard should have no ramifications on the group's consolidated financial statements. The rationale behind the implementation of AASB 12 was to provide a higher degree of flexibility for preparers of consolidated entities to tailor their individual disclosures to impart more savvy information that will better supplement the user's capacity to assess the nature and financial effects of the entity's reporting relationship with other entities. Innate with the principal objective of the standard, Murchinson will need to provide more comprehensive information relevant to the nature of and risk associated with the company's associated interests in other entities. However, given that the group's corporate structure is exclusively comprised of wholly owned subsidiaries and jointly arranged ventures, the extent of amendments will primarily reside in divulging unambiguous information of the group's direct interest with their accredited entities in accordance with this framework. The concluding statement to be assessed in this report is AASB 13. The principal basis used for implementing this standard was purely towards clarifying the appropriate method required to measure fair value for an asset or liability in an inactive market and endeavour to improve the transparency of fair value by additional disclosure requirements pertaining to the evaluation techniques and inputs used. In relation to the evaluation methods utilised by Murchinson, it is evident in this group's set of consolidated reports that developments have been initiated to accommodate for these changes. Cited examples include the group's fair value measure of equity settled transactions with use of a binomial model, and the justification of the value allocated to the group's trade and others payable. However, in retrospect of the succinctness of these cited examples, the quality of this accessible information may need to be reconsidered to satisfy the disclosure requirements of the standard. Regardless of this consideration, the principle that Murchinson is well positioned to contend with these implications of the AASB's amendment framework remains unchanged. Thank you for listening to our presentation.